Hey everyone, my name's Andy. My channel's Finding Value. Today we're going to go over Twitter, look and see what's going on there. I don't have too much else to really say with the overall markets being shut down on Monday. But we'll go over some information. We'll go over some things that Peter Lynch, a famous investor, go through some of his stuff, and I'll give you my financial opinion. So let's dive right in. And again, if you want to follow me, it's at finding_finance. So let's start with Peter Lynch. It says Peter Lynch compounded his money at 29.2% between 77 and 1990. This article with his 20 golden rules was the most popular article of 2022. So let's take a look at the most popular article for Peter Lynch. Here's 20 golden investment rules from one of the best investors in the world. So rule number 1, know what you own. You have to know what you own and why you own it. Rule number 2, never invest in companies without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets. Only invest in good companies and your return will increase dramatically. I talk about this on the website a lot, about being cash flow positive, hitting inflection points, going after profitable companies with infrastructure in place. And those basically were understanding what the finances could be if the commodity price has changed. Rule number 3, everyone has the brain power to make money in stocks. If you sell stocks in a panic, the stock market is not for you. Bear market and crashes are great investment opportunities. That's where you can gain all your money. Rule number 4, make use of your edge. Your investor's edge is not something you get from Wall Street experts. It's something you already have. Stock information can be found everywhere on your work. When you go shopping, make use of it. Basically what you see in the real world. And I've actually applied this one quite a bit over my investing years. Chipotle, Visa, MasterCard, United Health Group, a lot of those companies that I invested in during the right time frame, I've made a lot of money on. Rule number 5, amateur investors have big advantages compared to professionals. The stock market is dominated by a herd of professional investors. When you ignore them and think rational, you have a big advantage compared to professionals. Rule number 6, focus on the long term. There's no correlation between the success of a company's operations and the success of a stock over a short period of a few years. However, in the long term, stock prices will always follow the underlying fundamentals of the company. If the company does well, you will also do well as an investor. Long shots always miss the mark for rule number 7. Don't invest in hypes or the next big thing. Instead, invest in quality companies with a healthy balance sheet, high profitability, and good capital allocation. Rule number 8, don't over-diversify. Owning stocks is like having children. Don't get involved with more than you can handle. You should be able to analyze and follow up on every stock you have in the portfolio. When you know what you're doing and made your homework, you'll be able to take a good investment decision when they matter most. Rule number 9, have some cash on the sideline. If you can find attractive companies, put your money in the bank until you discover some. So basically, if you've got money, put it in something that's a good opportunity at that time. But if you can't find an opportunity, then just hold cash. It's always a good idea to have some cash on the sidelines. This allows you to invest heavily when Mr. Market has become too pessimistic. Rule 10, ROIC is key. You want to invest in companies with a good capital allocation. The return on invested capital is one of the most important metrics for quality investors. The higher, the better. So return on invested capital. Rule number 11, avoid hot stocks. Great companies in cold, non-growth industries are consistent big winners. For quality investors, the margin of safety lays in the competitive advantage of the company. Invest in great companies with strong track records. Rule 12, only invest in profitable companies. When you can find a small cap quality company which is a market leader in a niche, you have found a potential multi-bagger. Rule 13, let your winners run. If you invest $1 in a stock, all you can lose is $1, but you can stand to gain $10 or even $50 over time if you're patient. You need to find a few good stocks to make a lifetime of investing worthwhile. That's the risk reward. Rule 14, small is beautiful. In every industry, in every region, the observant amateur can find great growth companies long before professionals have discovered them. Do you notice something very interesting at your work or in a shopping mall and then basically invest in those types of companies? Rule 15, stock market declines are opportunities. If you're prepared, corrections can hurt you. Corrections are great opportunities to pick up bargains. It says corrections can't hurt you if you're prepared. And they go through the cycle that I go over a lot. Rule 16, there's always something to worry about. There will always be uncertainty in the economy and on the stock market. Sell a stock because the company's fundamentals deteriorate, not because the sky is falling. Time in the market is way more important than timing the market. Rule 17, don't look at macroeconomic factors. Nobody can predict interest rates, the future direction of the economy, or the movement of foreign currencies. Dismiss all such forecasts and concentrate on what's actually happening to the companies in which you've invested. Rule 18, there's always pleasant surprises to be found in the stock market. If you study 10 companies, you'll find one for which the story is better than expected. If you study 50, you'll find 5. The best thing that can happen to you is buying a stock that goes up 100 times your money. Rule 19, do your homework. If you speculate in stocks, you have the same chance of success as playing a poker game without looking at the cards. The stock market rewards people who do their homework. And rule 20, time is on your side if you own stocks of great companies. Time is on your side if you buy quality businesses. When the earnings of a stock goes up 10x, the stock price will follow. So that's his 20 rules, golden 20 rules for Peter Lynch. And he's done very, very well. One of the best investors in the markets. So keep those things in mind when you're looking for companies. Here's one. It says, more people expect a recession than any other point in recent history. This chart's from Jim Bianco, confirms our feelings. And here's 43.5% is the probability of a recession in the next 4 quarters. Compiled by a quarterly survey of professional forecasters conducted by the Philadelphia Federal Reserve. I'm curious to see if it actually transpires. In 1999, we had 27.5%, and the recession came later. 89, we had 78 a couple years later. So I think it's probably early on some of the calls. Some are pretty much nuts on. But yeah, that's what we've had. The probability of recession, some of the highest percent prediction. Here's Ronnie. It says, inflation hits miners. It's never been more expensive to build or operate a mine in the United States. So it's never been more expensive. And I talked about this quite a bit, how the mining companies and how to build a mine. I think that's going to get much, much worse in time. When we start to see shortages of minerals, ones that are found in the trucks that these guys operate, in the minerals that are used to build all of these mines, and I'm talking basic stuff like aluminum, zinc, all those other things, I think the costs are going to continue to rise. And we could come into a period where there's a lull. We'll call it this next year, where the base effect comes. We had some pretty high numbers in 2021 or 2022, and I think they'll slow down for 2023 just because of the year-over-year base effect. But I think it'll ramp up again at some point in the future. And I think oil is going to be one of the leading contributors due to the shortages of oil. And we're going to talk about that here as well. But I do think inflation with the price of oil going up in these mines, I mean, obviously we're seeing these gigantic trucks that eat through diesel quite rapidly. I think that we're going to see, more inflation. So here's Josh Young. It says, if you haven't stress tested your portfolio for oil prices north of $200, you're going to suffer dearly when that should come to pass. Companies think in 2023 is going to be a pivotal year for the price of oil. I think Josh Young thinks that. I think that. I think that we're going to see supply side problems in oil and demand remain pretty resilient with China reopening. So what does your portfolio look like at $200 oil? I am positioning for higher oil prices. I don't know if we'll hit 200 next year or not. Maybe we even hit higher. They were talking about $300 oil coming up. And really what they're saying is, if we have a swing where we go and run a deficit of 4 or 5 million barrels, where's that oil going to come from in the next few years? And not too many people know where it's necessarily going to come from in that type of quantity. So we could run a deficit for a while. The Strategic Petroleum Reserve releases, yeah, it basically tide us over for a period of time. But that time will pass. It will go behind us, and we're going to get into a pretty tight situation in oil, I think. And I'm not the only one who thinks that. There's a large divide on people who believe that oil is going to go much higher versus others that think demand destruction is going to contain it. I'll tell you honestly, I don't know which one will necessarily win in the short term, but in the midterm and long term, oil is going to crush the demand side problem because they're going to have to print money to save their bond markets. They're going to have to print money to save the system, so to speak. And there just isn't the oil there for that money to be absorbed. So what you're going to see is you're going to see money being created at a faster pace than GDP, and that's the type of environment that oil goes up in. Marco Popik, slides one, tactical. Everyone is bearish. So he says, everyone and their chocolate Labrador is currently bearish. That is not reason enough to be bullish, to be sure, but it does confirm our anecdotal sense from travel that the consensus is mega bearish. And we are way down here in terms of how bearish people are in the negative area. For institutional peers and retail investors are uber bearish. The retail guys are generally wrong, though. So they usually are bearish after they need to be bearish. And we could be going into basically a turning point at some point. They were ultra bearish in 08, 09. That's exactly when you should have been buying. And they're bearish again today. So, maybe it's the time we should be buying. Here is the decline of long-term investing. I know we went and we talked about Peter Lynch, and Peter Lynch made his money by basically sticking it out over a long period of time. And Warren Buffett does the same thing. It says, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And here we are, the decline of long-term investing and the holding period over these decades. 7 years, 4 years, 8 years for 1960s. And then a rapid decline, 5 years, 2 years, 2, 1.3, 1.1, and now 6 months. 6 months is nothing. That you're basically, if you're holding a stock for 6 months, you basically are just trying to time the market at best. And most of these people that try to time the market, they just lose money. So I guess people just continually lose money now. I've been in a lot of positions since 2020, and I'm still holding on. I don't see any reason to necessarily sell, and I'll probably be in this 8-year camp or something like that, maybe even longer. But nobody wants to hold stocks. And it's hard. It's hard because basically you're just rolling the dice if you're going to invest for only 6 months or less. You're just doing short-term technical analysis, and that's kind of the best thing that you could do if you're going to hold it for that period of time. And most of those investors, they just profusely lose money. So here it says, quite wrong. The transitory supply chain bros will push this linear view and get it wrong against trend most of the way up. And their view is when China demand opens, so does China's supply. Net, China opening is more deflationary than inflationary. Wrong, 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 wrong. I totally agree. And I agree with Paulo Macro. When they open up, China is more or less just a way of converting commodities and energy into usable products. That's it. And if you're short on commodities and you're short on energy, well, there's your problem. It's inflationary, not deflationary. It would only be deflationary if you had copious amounts of commodities available. But that's the problem. We don't. We are going to be short commodities. So when they open up, they're going to try to convert energy and commodities into products, which we don't have those commodities. The inventory is low. It says the majority of FinTwit is in absolute denial about the first half commodities are about to have and the ton of global inflation China's about to induce. And that deals with low inventories of commodities, China reopening, and then converting those commodities to usable products using energy. So that's where there's a large divide. The people, I'm in the camp with Cuppy and Paulo Macro and those guys, thinking that when China reopens, they're just going to try to consume things that don't exist, which is going to increase prices. And that's kind of where I'm at. This one is the stimmy train is finally back. China take extraordinary measures to stimulate growth. The government may raise its budget deficit to more than 3% of gross domestic product. Now here's Tavi. Hate to say, but we haven't seen anything yet. Prior to the GFC, the number of bankruptcies was rising exponentially. Today, it remains at historical low levels. The tightening of financial conditions worldwide is setting the stage for significant credit events ahead. But here's the problem. So everybody thinks that we get this crash immediately when this starts to go up. And I do think this will go up. I mean, I agree with that. Here, let me hit it right here. But we didn't have the crash till 2008, which is over here. It takes time, guys. It takes time. It may take a couple of years before these bankruptcies really start to hurt things. So I know everybody thinks that this financial crash is just going to happen because the numbers start to turn, but they turn and it may take a couple years. That's where I differ than a lot of other people. We could have a gigantic blow off top in uranium and oil before a big recession comes. Now, I'm not making that prediction. I'm stating that it's possible and that this is going to have to deteriorate quite dramatically before that necessarily happens. Here's Russia's, Dmitry Medvedev. Russia has an official oil price target of 150 a barrel. Oil prices will rise to 150 and gas prices will top $5 per 1,000 cubic meters. The UK will rejoin the EU. The EU will collapse after the UK's return. Euro will drop out of use as the former EU currency. That's his, I guess, predictions for 2023. Here's Cuppy. Yeah, he's talking to John Palmy. He says, "Trust me, John, I'm expecting it. 4 to 5 million is my baseline deficit, and then bad stuff often happens on the supply side when they miss. Then the real fireworks happen. Oil is the only thing that matters in 2023. Jay Powell is just a sideshow. Oil, oil, oil. That's what matters in the deficit that it's going to run." And Jerome Powell, he's just saying that's a sideshow. He doesn't matter what he does because of the large deficit that could potentially be there. He says in a 100 million barrels per day market, that appears to have limited spare capacity. This could be a problem. We didn't even talk about conclusion of SPR or Russian supply drop. We could be short 4 to 5 million barrels at some point next year, spike well above 100. No one is expecting it. That's right. So I'm expecting it. That's kind of what I'm thinking. Top picks for Eric Nuttall. Says, give Andy's website a try. This guy's up 151%, 75 and 60, depending on your time frame. I have a lot of really good picks on the website, just to let you know. And then China reopening, Beijing congestion index is way up, bullish oil with this reopening, and it's a dramatic increase over just a week ago. Lots more oil demand over in China. So that's what I've got for today, guys. I'm a big bull in oil. Don't forget the golden rules of Peter Lynch. I'm a long-term holder compared to, I guess, everyone else. Everyone wants to get in and get out and not really make that much money. I'm looking for multi-baggers, guys. I buy this stuff. I hold on. I'm looking for 5 times, 10 times my money or more. And there's still companies out there. I've got some that we're actually in the findinghighvalue.com website, the Platinum membership. We own some of them, and we're riding it. We're up hundreds of percents since I started the website. We will be doing some bumping and grinding sometimes because we're usually getting stuff off resistance, bumping, hitting, and then when it breaks through that resistance, that's when it runs. We've got a couple of setups right now where we're starting to run after that resistance. So a lot of fun times. If you guys like the content, give me a thumbs up, subscribe to the channel if you haven't, and we'll catch you next time. This is Finding Value.